What if the financial system you've relied on your entire life suddenly crumbled? As storm clouds gather on the economic horizon, this once unthinkable scenario is becoming a real possibility. In this article, we'll explore the convergence of three major forces threatening to upend the global financial order: banking instability, ballooning government debt, and the rise of BRICS nations. We'll also examine why diversifying away from fiat currencies might be a prudent strategy and provide insights into alternative assets for weathering potential economic turmoil. All sources referenced are included in the description below. The world economy stands at a precipice, with multiple crises looming. The United States, long considered the bedrock of global financial stability, faces unprecedented challenges. Its national debt has skyrocketed to a staggering $35 trillion, eroding purchasing power and threatening economic security. This massive debt burden isn't just an American problem. It's a ticking time bomb for the entire global economy. Meanwhile, the banking sector, still reeling from recent failures and instability, sits on a knife's edge. Financial institutions worldwide are grappling with unrealized losses and liquidity concerns, raising fears of a domino effect that could trigger widespread economic chaos. Adding fuel to this volatile mix is the growing influence of the BRICS nations: Brazil, Russia, India, China, and South Africa. This economic bloc is actively working to challenge US dollar hegemony, potentially reshaping the international monetary system as we know it. The US government's spending habits have long been a source of concern, but the situation has reached a critical juncture. With each passing day, the national debt climbs higher, casting a long shadow over America's economic future. The consequences of this fiscal recklessness are already being felt, as evidenced by a 25% loss in purchasing power over just 4 years. This raises a crucial question: can the government rein in its spending and get the national debt under control? History suggests otherwise. In times of economic hardship, governments typically resort to increased spending as a stimulus measure. However, the US finds itself in a precarious position, with limited fiscal maneuverability due to its overleveraged state. The ripple effects of this debt crisis extend far beyond American shores. As the issuer of the world's reserve currency, US economic instability poses a significant threat to global financial markets. The country's credit rating has already been downgraded, and major creditors like China have begun offloading US Treasury bonds, further eroding confidence in the dollar's long-term viability. The banking sector, often considered the lifeblood of modern economies, is showing alarming signs of weakness. Recent bank failures have exposed vulnerabilities in the system, leaving many institutions teetering on the brink of insolvency. One of the most pressing issues facing banks is the mountain of unrealized losses on their balance sheets. As interest rates have risen, the value of many long-term bonds held by banks has plummeted. While these losses remain on paper, for now, any forced liquidation could quickly turn them into real, devastating financial blows. This precarious situation creates a catch-22 for policymakers. Higher interest rates are needed to combat inflation and attract buyers for government debt. However, these same high rates put immense pressure on banks' balance sheets, potentially triggering a wave of failures that could dwarf previous financial crises. As the US grapples with its internal economic challenges, a formidable external threat is emerging in the form of the BRICS alliance. This group of emerging economies has been steadily working towards de-dollarization, reducing their reliance on the US dollar in international trade and finance. The BRICS nations have made significant strides in creating alternative financial institutions, such as the New Development Bank, NDB. While the NDB has faced its share of challenges and criticisms, it represents a concerted effort to build a parallel financial system less dependent on Western-dominated institutions. One of the most potent weapons in the BRICS arsenal is the potential widespread adoption of central bank digital currencies, CBDCs, within the bloc. These digital versions of national currencies could facilitate smoother cross-border transactions, bypassing traditional dollar-based systems and further eroding US financial influence. Given this perfect storm of economic threats, many financial experts are advocating for diversification away from fiat currencies, particularly the US dollar. But why might this be a smart move? Fiat currencies, backed only by government decree rather than tangible assets, are inherently vulnerable to economic shocks and policy decisions. The massive money printing undertaken by central banks in recent years has raised concerns about long-term inflation and currency devaluation. Moreover, recent geopolitical events have highlighted the risks of over-reliance on any single currency. The freezing of Russian assets following international sanctions served as a wake-up call to many nations, demonstrating how quickly dollar-denominated holdings can become inaccessible. So, how can individuals and institutions protect themselves in this uncertain economic landscape? While there's no one-size-fits-all solution, several strategies have gained traction among savvy investors. Precious metals, gold and silver have long been considered safe haven assets during times of economic turmoil. Their intrinsic value and limited supply make them attractive hedges against inflation and currency devaluation. Cryptocurrencies. While volatile, cryptocurrencies like Bitcoin offer an alternative to traditional fiat currencies. Their decentralized nature provides a degree of insulation from government monetary policies. Real estate. Tangible assets like property can serve as a store of value and potential income source, even in challenging economic times. Foreign currencies. Diversifying into a basket of different national currencies can help mitigate the risk of any single currency's decline. Commodities. Essential resources like energy, agriculture, and industrial metals often retain value during economic downturns and can provide a hedge against inflation. It's important to note that any investment strategy carries risks, and professional financial advice should be sought before making significant changes to one's portfolio. As we return to our opening question, what if the financial system you've relied on suddenly crumbled? It's clear that the convergence of banking instability, government debt, and BRICS ambitions poses a serious threat to the status quo. While a complete collapse of the current system remains unlikely, prudent investors are increasingly preparing for significant disruptions. The coming years may well see a reshaping of the global financial order, with a shift away from dollar dominance and the rise of new economic powers. By understanding these trends and taking steps to diversify their assets, individuals and institutions can better position themselves to weather the storm and emerge stronger on the other side. In this era of unprecedented economic uncertainty, financial resilience isn't just about preserving wealth, it's about adapting to a rapidly changing world. As the old adage goes, don't put all your eggs in one basket. In today's complex global economy, that basket might just be the US dollar.